Hello everyone, it's Elliot Gu here. We've had another wild week in energy markets with West Texas Intermediate crude oil, that's WTI crude oil, trading up close to $120 a barrel early last week, trading as low as $76.75 a barrel on Tuesday of last week, then rebounding all the way back to $98 and change on Friday, and then pulling back again in Monday's session this week. And of course, there was a ton of media attention directed at the coordinated 400 million barrel emergency oil reserve release, unanimously agreed by the 32 member nations of the International Energy Agency, the IEA, last Wednesday, I believe. Now, the U.S. alone will be releasing 172 million barrels of oil held in the Strategic Petroleum Reserve, that's the SPR, over a roughly 120-day period starting this week. Other major contributors include Japan, which will release about 80 million barrels, and the UK releasing around 13.5 million barrels. However, I want to focus on some stories that are getting way less attention in the mainstream media, but that I believe could be far more impactful over the intermediate term, even the short term, to be honest with you. Now, longtime readers know that I pay close attention to the Commitment of Traders report, which is released by the Commodity Futures Trading Commission, the CFTC, at cftc.gov on Friday afternoons each week, usually after the market close. So this report shows the gross long and short positions held by commercial and non-commercial traders in a long list of futures markets traded here in the US. Now, I update these numbers usually over the weekends, and what I'm generally looking for is extremes in sentiment in this data. So take a look at the latest data. Now, this particular graphic shows what's known as a Z-score for non-commercial traders' positions in 11 key commodity markets I track. Now, that's not, of course, all the commodity markets I track, but it's 11 that I've been watching particularly closely lately. Now, non-commercial traders are speculators, right? So these could be hedge funds looking to profit from a rise or a fall in the price of a commodity like oil or corn or soybeans. Now, commercial traders is a separate data set, which we'll examine here in just a minute. Now, those are hedgers. So those are companies looking to reduce their business risks. For example, an oil producer might use futures or options markets, these financial futures or options markets, WTI futures or options markets, to protect themselves against a decline in oil prices. Or a company like, Hershey's, who makes candy, right? They might use sugar futures to protect themselves against a rise in the price of sugar. So specifically, what you see here in the net non-commercial position, now that's the gross longs less gross shorts in both the futures markets and options on those futures markets for the speculators. So we're looking at speculators here. So I'm presenting it as a Z-score, and basically this is just a measure of how the current weekly position compares to the 104-week, obviously that's 2 years, moving average of the position. So a reading of +2, for example, would mean 2 standard deviations above the 104-week moving average. So that would indicate that speculators are very bullish that commodity. So I've included data for the past 2 weeks on here, so you can see how it's changed also over the last week. So the data released on Friday, March 13th, that's last Friday, Friday the 13th, reflects futures market positioning on March 10th. So that would be the Tuesday prior at the close. Those are the orange bars on this chart. And the data released on Friday, March 6th, reflected the data as of the close on March 3rd. So those are the blue bars on this chart. Now, what I'm looking for is situations where speculators are very bullish or very bearish a particular commodity. So generally the way I define that is I look for a Z-score of around -2, so around that level. It could be a little less or lower, right? Indicating extreme bearish sentiment, or a Z-score of around +2, or higher, indicating extreme bullish sentiment. Now, there are several markets evident here on this chart that jump out, right? On the energy side, I think natural gas is perhaps the most striking. The Z-score on March 3rd was -2.73, And that extreme bearish position only decreased slightly last week to negative 2.09 on March 10th. The speculators are very bearish natural gas, which right now is a signal to start looking for a bottom in gas, a contrarian long opportunity. Also note that the WTI futures market is seeing some significant swings right now. Now, speculators were only about plus 0.66 standard deviations bullish, almost nothing. As of March 3rd, not an extreme reading. But that did jump all the way to 1.54 standard deviations as of March 10th, last Tuesday. So, while we're not quite to a bullish extreme there yet, it's certainly 1.54 is certainly a level where I sort of sit up and take notice. And there is a signal here that speculators, again, the hedge funds and whatnot, they're starting to jump on the whole geopolitical risk bandwagon narrative right now. So I want to talk a bit more about why this natural gas setup I think is probably more interesting to me right now here in just a minute. However, first, let's take a quick look into that WTI, that oil data. Now, this chart shows the net position of commercial traders. These are the hedgers in the WTI futures and options markets. Again, the biggest category of commercial traders are going to be the producers, who are always net short oil. So they're selling oil or buying put options to lock in prices for their production, right? To protect themselves against a decline in prices. However, note that what I've drawn, that green arrow there, and this circle on my chart, right? This is a period from last summer, the summer of 25, into the first half of January 2026. Now, at the end of August, WTI, West Texas Intermediate Crude Oil, was trading around $70 a barrel, and oil prices fell to around $56 a barrel by mid-October, so a pretty rapid fall there. WTI then bounced around in a trading range between sort of the mid-50s and the low 60s, right, from mid-October 2025 up until mid to late January of this year. Now, during this time, the commercial position grew longer, okay? And what I mean by that is that commercials are always net short, but they became less short over this time. So that's a signal that they were allowing their existing hedges to expire, but they were not hedging aggressively. They weren't taking out aggressive new hedge positions. With oil prices depressed and trading either side of $60 a barrel, they simply didn't want to hedge. They didn't want to lock in those prices for oil. Now that's a very bullish signal. Now I wrote and spoke about this a great deal, late last year at the Money Show in Orlando, here in these videos I send out periodically, and also at the Money Show in Sarasota back in early December, and on a couple of YouTube podcast videos and interviews I've done. Simply put, there was plenty of talk in the media and on Wall Street late last year about a super glut of oil in early 2026. And that was expected by some to drive prices under $40 a barrel. But the producers, now these are the commercial traders, these are companies that actually participate directly in the oil market. This isn't some Wall Street firm. This isn't some, the IEA or some organization that looks to predict what inventories are going to be like. These are companies actually in this business, and they likely have, almost certainly have, some inside knowledge of production and drilling activity trends in key fields like the Permian Basin. Now, if they believed the superglut narrative that was all over the place late last year, then they would have been hedging at that $55 to $62 a barrel level, a level at many of them can actually generate free cash flow, protect their dividends or distributions, and the like, protect their share buyback plans. So they would be, if they thought that was likely, a superglut was likely in the first half of 2026, they would have been taking out hedges as protection against a drop to under $40 a barrel early this year. The fact that they were not is quite bullish. It means that they did not believe in the crowd view of this superglut narrative. Simply put, they weren't hedging because they didn't believe low oil prices were sustainable. The smart money didn't buy the superglut narrative. So now we're seeing actually the opposite situation, right? Last week, there was a lot of talk about the largest disruption to oil supply in history, much bigger than the early 70s, 1973 period, and the record-setting coordinated petroleum release I mentioned earlier from IEA. However, as you can see, commercials have been hedging very aggressively in recent weeks. That net position has been getting shorter. That net position has plummeted, in fact, by almost 67,000 contracts in just the past 2 weeks. Now, that's between February 24th, which is before the start of Epic Fury, the military action in Iran, and March 10th, which is last Tuesday, the latest data we have. Now, 67,000 contracts represents 67 million additional barrels worth of hedging activity. And since January 13th, so mid-January, I mentioned that time frame earlier, the commercials have layered in some 224.2 million barrels of additional oil hedges in WTI alone. Nothing to do with Brent, where they've also been hedging. Over this time, the price of oil has increased from, and I'm talking about WTI again here, from the low 60s in mid-January to the high 60s by late February, and then it spiked, of course, to as high as $100 a barrel or so late last week at the close, at the final settlement last week. So this suggests that producers believe some of the current geopolitical hype in the global oil market will fade over time. It's also important to note that there's extreme backwardation in the oil futures curve right now. And what that means is that the front month WTI contract closed very high levels, near $100 last week. But the July 2026 futures, so a few months out, are in the high 80s, so significantly lower. November 2026 futures settled last week in the high 70s a barrel. And by the spring of next year, of 2027, futures contracts are trading in the mid 70s a barrel. So the same producers who were refusing to sell at the super glut lows in 2025, refusing to hedge, so they're now selling this spike as fast as they can. They are telling us that while the headlines are bullish, they are more than happy to be sellers of $80+ a barrel oil for delivery later this year. My view has been and remains that we will see oil prices fade in coming weeks, particularly those front month contracts, which are totally based on geopolitical headlines. But the low price environment that we saw late last year, that's gone for good. There's a new higher floor in place. This is something I talked about on some of the videos and flash alerts I've sent out over the past couple of weeks. Now, I want to turn back to natural gas. Now, this is a market that's being totally ignored right now in favor of crude oil, right? Everybody's talking about oil. Nobody's talking about U.S. natural gas. Even though the global gas market has been completely upended by the situation in the Persian Gulf right now. Now, as I said, the speculators, the non-commercials, are now very bearish natural gas. This chart shows the net speculative position in NYMEX natural gas futures and options back to 2019 as a blue line. I've also included the 104-week Z-score using the right-hand scale plotted as an orange line. As you can see, speculators are about as bearish today on natural gas as they've been at any time in the last 7 years, except for a brief period back in early 2020. Now, this is the sort of bearish extreme that has me looking for a bottom in gas and opportunities on the long side in natural gas producers here in the U.S. who would, of course, benefit from higher U.S. natural gas prices. Now, of course, natural gas has been on a wild ride this past year. We had a warm start to winter heating season in 2026, and then we had that vicious cold snap in late January and early February, which I'm sure I don't have to tell many of you about. Winter heating season, that is a period of highest demand for natural gas here in the United States. So let's take a look at natural gas storage in the U.S. So far in 2026. So the blue line is the weekly storage level for each week of 2026 so far. And the orange line is the 5-year seasonal average. So the average level of storage over the 5 past full years for this time of year. Now the green bars show the 2026 storage changes each week compared to the seasonal average storage change for the same week. So a big negative bar implies a much larger than normal gas drawdown, which is bullish for gas. So normally storage would drop by less than we're actually seeing in 2026. So you can see those huge drawdowns amid this year's extreme cold snap. On the week ended January 30th, U.S. gas storage plummeted by 360 billion cubic feet, which is almost double the normal drawdown for that time of year of around 190. We did see some spikes in gas prices amid that cold snap. Front month gas futures spiked from $3.15 a million BTUs in mid-January to over $7 a million BTUs. However, after that cold snap, the weather has turned more benign. And in 3 of the past 4 weeks since mid-February, U.S. gas storage has seen a smaller than normal drawdown. Right now, as we approach the end of winter heating season here in the U.S. and the start of a seasonal lull in gas demand, we call shoulder season, before we start into summer cooling season, right? The forecast continues to show pretty mild weather, and storage is basically in line with the 5-year seasonal average for this time of year. However, while everyone here in the U.S. is focused on the oil market right now and the impact of Operation Epic Fury on oil prices, investors are ignoring the fact that the situation in the Persian Gulf also has a huge impact on the global gas market. You see, for the past couple of years now, there's been some concern in gas markets. If you listen to conference calls from the major gas producers, you've heard about this. The concern was about a potential glut of LNG, liquefied natural gas, on the global market centered in the 2027 to 2028 timeframe. Now, the world's 2 largest LNG producers are the U.S. and Qatar. U.S. LNG export capacity has been ramping up over the past few years. So here's a chart showing exports since January 2022. Now, thanks to the start of a number of new LNG export terminals, starting at the end of 2024, U.S. LNG exports have jumped from a little over 12 billion cubic feet per day back in September 2024 to over 18 billion cubic feet a day here in December of last year. So a period of just over a year, we saw a 6 billion cubic foot a day increase in U.S. LNG exports, right? And that growth is expected to continue into this year. So first we have the long-delayed Golden Pass LNG export facility that's being built by ExxonMobil in Texas. That's starting up right now, and it's expected to ship its first commercial cargo this month. Eventually, this project will export around 2.4 billion cubic feet a day of natural gas, though it'll likely take until late this year or even into early 2027 to get to that maximum capacity. Meanwhile, Venture Global's Plaquemines LNG project in Louisiana continues to ramp up. And just last week, they got permission from the U.S. Department of Energy to operate at a higher output level. So they're actually able to boost immediately export capacity by 13% from the Plaquemines export facility to about 3.85 billion cubic feet a day. Now, this was a direct response to the situation in Iran right now. Now, Cheniere Energy's Corpus Christi Stage 3 project, that's also progressing, with the final 3 trains expected to be online this summer. So by the summer, we could see U.S. LNG capacity well above 19.5 billion cubic feet a day. Now, Qatar Energy, the second largest LNG exporter in the world, has also been planning to boost its own LNG export capacity through a series of expansions. Specifically, at the end of 2025, at the end of last year, the country's total export capacity was around 77 million metric tons per year, which is a little over 10 billion cubic feet a day. Okay? The company's North Field East expansion was expected to go into service late last year or early this year, adding about 4.2 billion cubic feet a day of new capacity, of new export capacity from the country. Now, that was to be followed by the North Field South expansion sometime in the 2027 or 2028 timeframe, adding another 2.1 billion cubic feet a day, right, of export capacity, and the North Field West expansion in 2029, 2030, adding a further 2.1 billion cubic feet a day. The concern was with both Qatar and the U.S. adding LNG export capacity so quickly, there would be a short-term glut on the market in that 2027 to 2028 timeframe, as demand would take a few years to catch up to this surge in supply. However, look at this. Now, this is a map of the Persian Gulf region where I've put Qatar right in the center. You can see it right there, right? I put right in the center of the map. As the name implies, the country's North Field is, surprise, surprise, located just north of Qatar in the Persian Gulf. Now, that's an offshore gas field. However, it's actually the largest non-associated gas field in the world, which means that the gas isn't found naturally occurring with crude oil. However, the reservoir continues across the maritime border into Iran. Okay? Now, the Iranian side of the field is known as the South Pars field. In fact, this situation was a huge issue long before Operation Epic Fury. Qatar Energy has been investing in infrastructure to produce gas from this field for many years, and they've been utilizing advanced Western oil field technology to produce the field very efficiently. It's a high-quality operation. Meanwhile, Iran hasn't invested adequately in South Pars, and they don't have access to Western oil field technologies, mainly due to sanctions. As a result, the reservoir pressure on Qatar's side of the border has been dropping faster as the country produces the field, pulls more gas out of the field. And that's leading to a migration of natural gas and other hydrocarbons, mainly natural gas liquids, from the Iranian side, the South Pars side, to the Qatari side. What's more important right now is that Qatar's LNG projects are all located right in the center of the current conflict. With the closing of the Straits of Hormuz, Qatar has declared force majeure on its LNG exports. There have also been drone attacks on the infrastructure at Ras Laffan. Now, this is the main offshore site for LNG production. It's located on the northern part of Qatar. As a result, the North Field East expansion of 4.2 billion cubic feet a day expected for startup this year, well, that's been delayed until next year, 2027, at the earliest. The longer this conflict goes on, the more likely it's going to be pushed back even further than that. Meanwhile, North Field South, which was expected to enter service in 2027-28 and was already under construction, that's more likely a 2028 or 2029 story now. In short, the big wall of Middle Eastern gas previously expected to come online between 2026 and 2028, that's now been pushed further to the right, further out into the future. And the longer the current disruptions persist, the more likely Qatar's projects will be further delayed, as I said. That leaves the U.S. as the only game in town for countries wanting to import more LNG. On top of that, even if the conflict in the Persian Gulf region were to suddenly de-escalate, it'll still take some time for Qatar to repair damage to its facilities and restart LNG exports at normal levels. Now, this is a big problem, particularly for the European Union and the United Kingdom. You see, on February 3rd, the EU passed a new law called Repower EU, mandating that all Russian LNG supply is phased out of the market by December 31st of this year. Again, the end of this year. The law also mandates all Russian pipeline gas supply be phased out by September 30th of 2027, next year. Importantly, the law also bans any short-term LNG imports from Russia starting April 25th of this year, just a little over 5 weeks from now. After that date, all EU LNG imports must be those from Russia, must be those contracted under long-term supply deals, not spot cargoes or shorter-term contracted deals. The plan was to replace Russian gas supply with LNG cargoes from, you've probably guessed it, the United States and Qatar. And the second half of that strategy has now been completely upended. Ironically, in the short term, this has forced the EU to port way more Russian gas. I'm throwing a map up here on your screen so you can get a better idea of what's happening. with Russian gas right now. So the EU purchased 100% all of the 21 LNG cargoes produced at Russia's Yamal LNG facility. And as you can see, that's located up in extreme northern Russia in the Arctic region. So they actually booked all those cargoes from Yamal in February. And through mid-March, March 14th, every single cargo produced at Yamal is also destined for Europe. So they've been snapping up these cargoes as fast as they can. Now on March 4th, Russian President Vladimir Putin explicitly threatened to halt those supplies to the European Union and ship to Asia instead, since Europe is now mandating that all imports of Russian LNG end later this year anyway. And since many of these emergency imports from Yamal are short-term deals or spot cargoes, the window slams shut on 30 to 40% of Europe's Russian LNG supply in about 5 weeks, a little over 5 weeks now, on April 25th of 2026. To add to the problems, a sanctioned Russian LNG carrier ship, tanker ship, the Arctic Metagaz, carrying LNG from Russia's other terminal up there in the Arctic, the LNG 2 facility, that was attacked in the eastern Mediterranean earlier this month, allegedly by Ukrainian maritime drones. Now that ship was headed toward the Suez Canal and likely ultimately China, but was partially sunk and is now a ghost ship drifting near Malta. Europe is in a desperate race against its own laws. They have legally mandated a ban on Russian gas for 2027, but in March 2026, they are buying 100% of the Arctic supply from Russia just to keep the lights on because the Qatari alternative is effectively blocked. Using more Russian gas to supplement US LNG volumes is Europe's only remaining lifeline. And Europe desperately needs more gas. As of March 14th, Germany's gas storage was sitting at 22% of capacity, down 13.6% from 1 year ago. The Netherlands' gas storage is critical at less than 9% of capacity, down 17.7% from a year ago, with the EU average at 29%, down 5.8% year over year. That's buoyed by the likes of Italy, which is sitting at 45.5% of capacity. Now, Italy has some unique advantages. The main one being they have preferential access to African gas volumes, both from North Africa via a pipeline, as well as a project in Mozambique, an LNG project that their national oil company, Eni, ENI, which does trade here in the U.S. under the symbol E, has invested in these projects. And they've been maintaining both pipeline and LNG supplies and infrastructure from Africa. This was while other countries like Germany and the Netherlands relied heavily on Russian volumes, import volumes, and a troubled energy transition favoring intermittent renewables. That's, let's be honest, it's failed miserably both in terms of energy security, obviously, evident now, and cost. Now, I've thrown up a map here to give you a better look at what's happening in Italy right now. Indeed, Italy is now exporting gas north into Germany thanks to a permanent reversal of the transit gas pipeline. Now, without that, Germany would likely already be breaching its 15% storage emergency threshold, threatening its industrial base. The big winner in natural gas longer term, that's the United States. With Qatar LNG cargoes off for now, key LNG importers in Europe and Asia, they're engaged in a bidding war for any U.S. LNG spot cargoes they can get their hands on. And that's also why the U.S. Department of Energy authorized that 13% increase in export capacity from Plaquemines I mentioned earlier this month. So longer term, with Qatar's expansion plans likely to be significantly delayed, that temporary LNG glut people were talking about last year in that 2027 to 2028 timeframe, that looks more like a supply shortfall right now. Meanwhile, the situation today shows that while Qatar certainly has huge gas reserves in the North Field, U.S. LNG supply looks a lot more reliable from a supply perspective, less sensitive to geopolitical conflicts in the Middle East. So we're seeing increased interest in signing long-term 20-year SPA deals, sales purchase agreements, for U.S. LNG supply right now. So right now, the NYMEX 2027 calendar strip for natural gas, well, it's around $3.85 a million BTUs. So what is that? That's the average settlement price for all natural gas futures contracts for delivery in 2027, so next year. Without the expected wall of Qatari supply, that looks insanely cheap to me. And the pull on U.S. LNG is going to remain elevated for the foreseeable future, not glutted, as some thought late last year, early this year. Now the commercials, again, these are the smart money, the hedgers. Their hedgers are bullish, and they're not hedging. And the speculators are bearish due to short-term weather-related drivers. Now this is a textbook bullish setup for gas producers and key gas infrastructure players, such as those we recommend in the model portfolio. Now, bottom line, with all the headlines focused on oil, don't ignore the arguably bigger impact on the global market for natural gas. 20% of the world's natural gas supplies move through the Strait of Hormuz. And if you're interested in our exact recommendations to benefit from the shifts currently underway, why not take us up on our free trial offer, available for a limited time via the link below this video only. So thanks again for listening. I hope you found that useful and I hope you learned something. And I look forward to greeting some of you as new free trial members to the service here in just the next few minutes. Thanks again.